Every 4 years, someone asks the same question. Will the stock market do better under a Republican or a Democrat? The honest answer is weirder than politics. The same index, the S&P 500, has lived through 17 presidencies, a Great Depression, a World War, oil embargoes, the dot-com bubble, the 2008 meltdown, COVID, and an AI mania. This video is not a political scorecard. It's the story of what happened to stocks while each president was in office, and why the number on the chart often has more to do with luck and era than with who gave the speeches. Before we go president by president, the rules. We measure one thing. How much did the S&P 500 rise or fall from inauguration day to the last day in office? Same yardstick for everyone. It's not GDP, not jobs, not approval ratings. Just the market's verdict on that term. And yes, Hoover uses a composite estimate for the Depression years because daily data back then is messy. Trump's second term is still in progress. We start with a nightmare scenario. Herbert Hoover became president in March 1929. The economy looked strong. The market had been roaring. 6 months later, Black Tuesday. Banks failed. Unemployment exploded. By the time Hoover left in 1933, stocks had lost roughly 77%. Historians still argue how much any president could have done in 4 years against a deflationary spiral. But this is the number every other president gets measured against. Hoover didn't single-handedly cause the Depression, but he owned the worst market term on our chart. Franklin Roosevelt took office at the bottom of the Depression, March 1933. Banks were closed. Fear everywhere. Over 12 years, the market rose about 107%. The New Deal rewired the economy. World War II then mobilized American industry at a scale the world had never seen. Harry Truman inherited that machine and rode the post-war boom, another 85%. Then, Dwight Eisenhower, highways, suburbs, the baby boom, 129%. Notice the pattern. This wasn't one president's genius. It was a country rebuilding for 20 years. The easy years ended. Richard Nixon, Watergate, Vietnam, and the first oil shock finished with stocks down about 20%. Gerald Ford and Jimmy Carter both eked out small positive returns. But inflation was eating the economy alive. Stagflation, high prices, weak growth, miserable mood. In August 1971, Nixon also broke the dollar's link to gold. The Nixon shock and currency chaos added to the stress. This stretch is the reminder that presidents don't get a bull market coupon. Sometimes the macro environment just punishes everyone. Paul Volcker at the Federal Reserve had already started breaking inflation's back before Ronald Reagan arrived, painfully with double-digit interest rates. Reagan's era still saw stocks rise 118% as confidence returned and the Cold War wound down. George H.W. Bush, the elder Bush, added 52% through the Gulf War and the early 90s. Then, Bill Clinton, about 210%, the best single term on our chart. The internet rewired the economy. Budget deficits turned to surpluses. Multiples expanded. Clinton gets credit for the boom and catches blame for the bubble that burst right after he left. Now the lesson everyone argues about. George W. Bush's presidency included the dot-com hangover, 9/11, and the 2008 financial crisis. Lehman Brothers, September 2008, the scariest month many investors had ever seen. His full 2 terms finished near minus 37% on the S&P. Barack Obama took the oath in January 2009, almost exactly near the market bottom. The Federal Reserve cut rates to 0 and launched quantitative easing. Stocks rose about 181% over 8 years. Same country, overlapping crises, opposite scorecards. This is why serious people say, it's not just who was president, it's where the cycle was when they started. Donald Trump's first term, corporate tax cuts, a trade war with China, then COVID, the fastest crash and rebound many of us have ever lived through. Net result, about 67% for the full term. Joe Biden faced an inflation spike, the fastest Fed hiking cycle in decades, and then an AI-driven rally led by the Magnificent 7 tech stocks, 56% over 4 years. Trump's second term is still being written. Tariffs, volatility, a number that moves every week. The story isn't finished yet. Okay, so if presidents aren't the whole story, what is? 4 forces show up again and again in this timeline. Number 1, the Federal Reserve. Volcker crushing inflation in the 80s. Bernanke at the 2008 bottom. Powell hiking into 2023. Rates and liquidity often move markets more than any Oval Office speech. Number 2, wars and oil shocks. The 1973 embargo, the Gulf War, Russia and Ukraine. Energy prices spike, consumers pull back, multiples compress. None of that fits on a campaign bumper sticker. Number 3, where you start on the cycle. Obama looks like a market genius, partly because he was sworn in near the 2009 low. George W. Bush looks terrible, partly because he presided over 2 recessions and a bubble peak. Timing is half the grade. Number 4, secular technology waves. The post-war industrial boom, the personal computer, the internet, smartphones, AI today. Presidents ride those waves. They don't invent them. So should you vote with your portfolio? Probably not. The data says presidents matter at the margin. But the Federal Reserve, wars, energy shocks, and whether you inherit a crash or a boom matter more. Clinton's huge number partly reflects the 90s tech revolution. Hoover's disaster partly reflects timing no human could fix in 4 years. Next time someone shows you a president versus market chart, ask what era they started in and who is running the Fed. If you want more history told through numbers, subscribe to Tickertales.